Okay, good afternoon, everybody, and welcome back. Today is Monday, November 18th. Today we'll be finishing up all the content for this class. We'll be covering Chapter 20. Chapter 20 deals with estates and trusts, their nature, and the accountant's role. Once again, I want to remind everybody that, as we can see here, Chapter 14 homework is due this evening. So make sure everyone gets that in. And once again, I made up my mind I will not be putting the results for Chapter 14 or Chapter 20 homework up. I want to see what everyone can do on their own moving forward, so don't wait for the homework solutions to be posted. I will post them after it's due, but just make sure everyone gets that homework in. So once again, we'll be going over Chapter 20 today. I'll post Chapter 20's homework. Chapter 20 homework will not be due until the Monday after Thanksgiving break. As we can see, next week will be on Thanksgiving break, so there'll be no class. And once again, so the week after Thanksgiving break, we'll have Chapter 20 homework due, and we will have the Exam 3 preparation. We will get through Chapter 20 today, so just ignore this. I will make the adjustment as necessary in Moodle. So with that being said, let's go ahead and get started on Chapter 20. So estates and trusts, their nature, and the accountant's role. Let's look at what our learning objectives are for this chapter. We're going to describe the goals of estate planning. We're going to account for the various factors that affect estate principal and income. Describe the various forms in which an estate may be distributed. Explain how one's estate is taxed and how such taxes may be minimized. Explain what a trust is and what the basic accounting issues are. Okay, so before we get started here, digging into the content, let's just start off by looking at a few key terms regarding estates and trusts. So a decedent is going to be the deceased individual. A will be a legal declaration containing directions as to the disposition of property. A died testate is a decedent has left a will. So in this case, obviously the decedent left a will. Probate court is going to determine the validity of a will. Probate process identifies the decedent's assets and liabilities, determines asset values, disperses assets to pay debts and taxes, and distributes the net assets of the estate per the instructions in the will. The executor is the fiduciary responsible for the administration of a will, and he's going to be named or nominated in the will. It can also be a personal representative. An administrator, if necessary, a court-appointed individual, is going to be responsible for the administration of a will. Died intestate, this is a case where a decedent has no will. Inter vivos trust is going to be a trust formed during one's lifetime, which passes property to one's heirs without a will, and therefore avoids the probate process. It can also be known as a living trust. Probate estate is going to be the decedent's assets which pass to the others by means of a will. Gross estate is the assets of an estate which are considered for federal and or state estate tax purposes. Corpus, this is going to be the assets of an estate, also known as the principal. Joint tenancy, property passes in its entirety to the surviving tenant and is excluded from the decedent's estate. Community property, only the decedent's interest in such property is included in the estate. Homestead or family allowance, certain assets of the decedent which are exempt from the probate process and are intended to support the family homestead and its members. All right, so those are the key terms regarding estate trusts. So now we'll go ahead and get into some of the other material. So an estate consists of the net assets of an individual at the time of his or her death. Now, until these net assets are completely distributed or consumed, the estate also exists as a separate, distinct entity that is governed managed, and accounted for. Oftentimes, the net assets of an estate are distributed to a trust, which is also a separate, distinct entity. Now, persons who are responsible for the management of the net assets of an estate or trust have a fiduciary responsibility. Once again, these persons are called fiduciaries. Now, what is the role of estate planning? Proper estate planning for individuals with sizable asset values is going to involve estate tax and gift-giving strategies. As the net assets of an estate increase in value and in nature, so does the complexity of the necessary estate planning. Now, as the complexity of an estate increases, so do the goals of estate planning, which should include the following steps. The first thing is we want to discover and clearly communicate the desires and wishes of the decedent. We want to ensure that the estate is administered or managed properly in order to satisfy the desires and wishes of the decedent. We also want to maximize the economic value of the estate's net assets through proper planning before death. We want to minimize the taxes that may be assessed against the assets and income of the estate. Define the necessary liquidity of the estate's assets so that desired conveyances and distributions may be achieved, and also provide a proper and timely accounting of the activities of the estate and its fiduciary. Now, how do we communicate through a will? It is critical that prior to death, the person communicate through the creation of a valid will, which is a legal declaration containing directions as to the disposition of the property. Now, when an individual dies having left a will, the decedent is said to have died testate. The will is presented to a probate court, which determines the validity of the will and identifies the fiduciary responsibility, or who the fiduciary responsible for administering the will. Now, probate law is developed by each state. The Uniform Probate Code was designed in part to encourage uniformity of probate law among states and simplify the probate process. Now, a fiduciary responsible for the administration of a will may be named or nominated in the will. This person is going to be referred to as the personal representative or an executor. If the will does not name a personal representative, or the representative is unable to serve, the court will appoint a party that is going to be referred to as an administrator. Now, if a decedent has no will or an invalid will, the person is said to have died intestate. In this situation, the probate court appoints an administrator and distributes the net assets of the estate according to the state inheritance laws. Now, usually the order of the distribution is to the spouse, children, grandchildren, parents, grandparents, and then collateral relations such as siblings, aunts, and uncles. In many states, if there is a spouse and children, the estate is split, one half to the spouse and one half to the children. Many individuals prefer to avoid the probate process. The process takes time and money, and the probate documents are public. An inter vivos or living trust is a popular way of passing property to one's heirs and avoiding the probate process by transferring property to the trust. So, identifying the probate principle of an estate, also known as the corpus of an estate. Now, one of the first responsibilities of the fiduciary of an estate is to identify the assets of the estate. A decedent may have two types of estates. The first being the probate estate, which includes all the decedent's assets passing to others by means of the will. The other is the gross estate, which is used to determine the federal and state estate tax liability. The assets of the estate are referred to as the principal or the corpus of the estate. These assets vary in nature and must be measured at their fair market values. Now, in identifying the principal, the fiduciary must identify or inventory those assets that were the legal property of the decedent at the time of the death. The assets will include accrued items such as interest and rents, And items frequently comprising the estate principal include the following things. The first thing would be cash on hand and in bank accounts. Investments such as stocks, bonds, mutual funds, retirement accounts, money market funds, and survivorship annuities. Accrued interest and declared dividends on the above investments as of the decedent's death. Capital interests in business such as closely held corporations, partnerships, and or sole proprietorships. Life insurance proceeds that are receivable by the estate or the result of the decedent having an ownership interest in the insurance policy. Therefore, if the decedent or the estate has an incident of ownership, the proceeds are included in the estate. Investments in real estate, including accrued rents at the date of the decedent's death. Intangible assets, such as patents and royalties, including related accrued income at the date of the decedent's death. Loans or notes receivable, including accrued interest at the date of the decedent's death. Unpaid wages and other forms of earned income accruing to the decedents at the date of the decedent's death. And personal valuables, including furniture, fixtures, jewelry, vehicles, boats, and collectible items such as coins, stamps, and artwork. So the preceding inventory of the principal is not reduced by the liabilities of the decedent. These obligations are going to be recognized when they are paid or satisfied through the distribution of the estate principal, rather than being immediately recognized on an accrual basis. Exempt property and special allowances. Certain types of assets generally pass outside of the probate process. For example, real estate, investments, and bank accounts that are owned jointly pass to the surviving joint owner. This requires that the ownership in such assets is titled as joint tenants. Although exempt from probate, the interest owned by the decedent is included in their estate for tax purposes. Now, although part of the probate estate, other assets of the decedent may be removed from the estate principal by way of a homestead allowance and a family allowance. Such assets are intended to support the family homestead and its members. Such allowances differ significantly from state to state. Accounting for the inventory of a probate estate. After the special exemptions and allowances for estate assets have been provided for, the fiduciary must file a report with the probate court identifying the estate principal. An initial accounting of the estate principal requires an entry debiting the various assets at fair value and crediting estate principal account. So if everyone would, as they're going through this lesson, if you would take and look on page 1034, it starts on page 1033 at the bottom. There's an example that demonstrates the initial accounting for estate principal. I want everyone to go through and read through that example and just look at the journal entries. It's straightforward. I'm not going to go through it verbatim right now in class, but it is important that everyone looks at this. And once again, this is just debiting the various assets and crediting the estate principal. It also goes through with the end part of this slide as well, with where you debit the cash and credit appropriate assets. So everyone, once again, please go through that example in the book, starting on the bottom of page 1033 and finishing up on 1034. Identifying claims against the probate estate. The discovery and identification of claims against the decedent's estate are of equal importance to the discovery and identification of estate principal. Notification of the decedent's death to creditors is required by law, and valid claims must be identified within a prescribed period of time. The fiduciary must evaluate the validity of claims and place them in an order of priority for payment purposes. The order of priority varies from state to state. Now, the following order of priority is assumed to be an example of this. So claims having a special lien against property, but not to exceed the value of the property. Funeral and administrative expenses. Taxes, income, estate, and inheritance. Debts due to the United States and various states. Judgments of any court of competent jurisdiction. Wages due domestic servants for a period of not more than 1 year prior to the date of death, and medical claims for the same period, and then all other claims. Now, within a class, each claim is satisfied on a pro-rata basis if funds are inadequate to accomplish the total payment for that class. Measurement of estate income. For a number of reasons, including tax implications, it is necessary for the fiduciary to carefully analyze activities and also determine whether they affect estate corpus and/or estate income. Income is the return derived from the use of estate principal assets after the date of death. Furthermore, a decedent's will may stipulate certain provisions regarding estate income that differ from those regarding principal. A will might stipulate that the interest income earned on bonds subsequent to the decedent's death is to accrue to a particular beneficiary for a period of time. The recipient of the income is going to be referred to as income beneficiary, and the party ultimately receiving the principal is referred to as the remainderum. Now, it is not always clear as to whether or not a transaction impacts estate corpus, and if so, to what extent. For example, if a stock held at death is subsequently sold, should the appreciation subsequent to death be considered part of the original corpus? Answers to such specific questions may be found in the decedent's will or applicable state laws. When defining estate income, careful attention must be paid to the provisions of the will and/or the estate statute. Many states have adopted the Revised Uniform Principal and Income Act, which provides guidance as to the measurement of the estate principal and income. Generally, one would expect income to include the following things: rents collected or accrued on principal assets, interest on monies lent, interest and dividends received on principal assets which were not accrued or declared as of date of death, business profits including farming and extractive endeavors such as mining or timbering. Now, income does not include the gain or loss on the disposition or transfer of estate principal, nor does it include changes in the form of principal. Income also does not typically include the cost of investing or reinvesting principal assets or the payments on indebtedness associated with the principal assets. One would expect charges against income to include the following: ordinary expenses incurred in connection with the principal assets after the date of death, such as ordinary repairs, taxes, and utilities, professional fees associated with income issues and the management for income. Now, for example, a portion of the trustee's compensation associated with income, taxes imposed on income, and a reasonable allowance for depreciation on property, typically subject to depreciation per generally accepted accounting principles, as well as an allowance for depletion. Distributions of property. Now, after the debts of an estate and the applicable estate taxes have been determined and paid, the fiduciary must focus on carrying out the remaining provisions of the decedent's will as they relate to principal and to income. Now, in a testate situation, a distribution of real property is a device, and the recipient of the property is the devisee. Distributions of personal property are called bequests or legacies, and the recipient of personal property is called the legatee. Ligeti. Distributions of property. Device C, once again, distribution of specific testate real property. Device C, recipient of the testate property. Legacies. Distributions of personal property, also bequests. Legatee is recipient of personal property. Some more on distributions of property. A device is usually a distribution of a specific piece of real property. In contrast, legacies may include one or more of the following types. First, a specific legacy. Which is a gift of a particular specified thing, distinguishable from others. The second being a demonstrative legacy, which is a gift of an amount from a specific source, with the will stipulating that if the amount cannot be satisfied from that source, it shall be satisfied from the general estate. If proceeds are inadequate to meet the amount, the difference shall constitute a general legacy. A general legacy is a gift of an indicated amount or quantity of something. A residuary legacy is composed of all estate property remaining after assigned to specific demonstrative and general legacies. If the remaining estate principal, after paying debts and expenses, is not adequate to satisfy the various legacies, a process called abatement is followed. Abatement is going to require that the legacies be satisfied to whatever extent possible in the order in which they are presented above. If the amount of assets designated as a general legacy is not available, the available amount is abated proportionately among the recipients. The charge and discharge statement. Periodically, the fiduciary will prepare a report to the court summarizing the results during the period of stewardship. This report is going to be called a charge and discharge statement or a final account. The preparation of the report is simplified if a double trial balance has been prepared. Since the charge and discharge statement is divided into two parts, one as to principal and one as to income. If the fiduciary had completed his or her responsibilities to the estate, all assets comprising estate principal and income would have been distributed. In this case, the charged and discharged statement would reflect zero balance as to the estate principal and income. Final distributions of estate principal often are made in the form of a residual legacy and or a trust for the benefit designated parties. After all final distributions, the estate records are closed with the estate principal and the estate income accounts serving as clearing accounts. Now, a good example of the charge and discharge statement is shown on page 1039 and continued on page 1040 of the text. So if everyone would, just take some time as studying and going over this lesson and pause it and take a look at this charge and discharge statement so that you get an understanding of what this statement looks like and what all is on it. Tax implications of an estate. During one's lifetime, certain transfers of property may be subject to gift tax, and certain transfers upon death may be subject to estate tax. The federal gift and estate tax rates are the same and are referred to as the unified transfer tax rate. There is also a unified credit amount that may be used to reduce the tax associated with gifts and estates. Although most estates are not subject to estate tax, for those that are, a major claim against the assets of an estate may result from the imposition of a federal estate tax, estate tax, or estate inheritance tax. An estate is considered to be a separate, distinct taxable entity during the period of administration or settlement, although this period of time may not be unduly prolonged. The estate will be considered terminated after a reasonable period of time is allowed for administration and settlement. Minimizing the taxes imposed on an estate is a very complex topic, and prudent estate tax planning is critical. During one's lifetime, serious consideration should be given to how various divestitures and trusts could be used to manage one's taxable estate. In addition, proper planning should address the following considerations: maximizing benefits of the marital deduction, making gifts during one's lifetime, taking actions to accomplish a step up in property basis, taking actions to benefit from a loss in property values, utilization of charitable deductions, planning estate liquidity. Recipients of gifts or estate assets do not pay the gift or estate tax, nor do they pay income taxes on amounts received. The gift tax is paid by the party making the gift, and the estate tax is paid by the estate. Taxable gifts and taxable estates are taxed at the same rate schedule, which is going to be referred to as the Unified Transfer Tax Rate. The tax rates are progressive in nature and have changed over time. On page 1042, there's an example of the Unified Transfer Tax Rate schedule for the year of 2014. So if everyone would just take a look at that tax schedule, and that way you can get an idea of how this Unified Transfer Tax Rate schedule actually works. Estate reduction with gifts. The taxation of an estate can be a complex process and is dependent on the proper assessment of a number of factors. One of those factors relates to the gifts that have been made during one's lifetime. As estates grow in size through inflation, investments, and capital appreciation, the importance of minimizing estate taxes also is going to be increased. One simple way to reduce taxable estate is to annually make non-taxable gifts. Currently, in the year of 2014, which is obviously dated now, but at the time that this book was published, the first $14,000 or $28,000 with the consent from a spouse gifted to any person during any calendar year is excluded in determining taxable gifts. This is an annual exclusion and is scheduled to change due to inflation indexing. Spouses also can make gifts to each other. No matter what the amount, such gifts between spouses are not subject to gift tax. Charitable gifts, tuition payments made directly to an educational organization, and or medical payments made on another's behalf are not considered taxable gifts. Now, if the payment was made to the individual and used for educational or medical expenses, it would be considered a taxable gift if it exceeds certain defined amounts. Transfers that do not qualify as non-taxable gifts are therefore deemed to be taxable gifts and are subject to the tax based on the Unified Transfer Tax Rates. So Unified Credit. It's a lifetime credit. It's going to be applied against gross tax on taxable gifts. Currently is the first $1 million of otherwise taxable gifts is going to be tax-free. And the unified credit that is applied against assessed gift tax is not available as a credit against estate taxes. Federal estate taxation. So significant changes regarding gratuitous transfers of property resulting from the Tax Reform Act of 1976. Prior to its enactment, transfers of property during the owner's lifetime were subject to the federal gift tax, while property passing as a result of death was subject to the federal estate tax. As a result of the Tax Reform Act, the separate gift tax and estate tax were combined into the unified transfer tax, which addresses both life, gift, and death transfers made after 1976. Taxable gifts and taxable estates are both taxed at the same rates, the unified transfer tax rate. However, the tax associated with gifts and the tax associated with an estate must be separately determined. Now, the computation of the federal estate tax may be summarized as follows. You start out with the gross estate, less deductions allowed. That'll leave us with the taxable estate. Then we add post-1976 taxable gifts. That'll give us the unified tax base. The tentative tax on total transfers, less tax credits, will give us the estate tax due. Now, the starting point for the computation of the federal estate tax is the determination of the gross estate, which includes the fair market value of all property in which the decedent had an interest at the date of the death. Now, this is regardless of the nature of the property or to whom it passes. Whether it is real or personal, tangible or intangible, business or non-business, the property is includable. The taxable estate is determined by subtracting the total of the followable allowable deductions. Allowable expenses such as funeral expenses and costs of administrating the estate, indebtedness against property included in the gross estate, such as a mortgage and other debts of the decedent, unpaid property and income taxes of the decedent to date of death, uninsured losses from casualty or theft of estate assets during the period of settlement, transfers to the United States, any state political divisions of a state or charitable organizations specified by the will, state inheritance taxes, and marital deduction, which is going to be limited or which is going to be unlimited in amount for estate property that passes to surviving spouse if he or she is a U.S. citizen. Now, the unified transfer tax approach requires that the taxable estate be increased by any taxable gifts made after 1976 by the decedent prior to death. In order to make sure that the unified credit used to reduce gift tax reduces the unified credit on estate tax, the post-1976 taxable gifts are added to the taxable estate in order to arrive at a unified tax base. Adding taxable gifts to the taxable estate results in a unified tax base to which the unified transfer tax rates are applied, which in turn results in a total unified tax on total transfers. This is for during life and upon death. Application of the tax rates to the unified tax base results in a tentative estate tax, which is then reduced by certain credits, and the net tax is due 9 months from the date of death. The two most common credits relate to taxes paid on post-1976 taxable gifts and the unified credit. Additional credits against the tax due are based on state death or inheritance taxes paid and foreign death taxes. After recognizing applicable credits, the net tax due is paid out of the principal of the estate. If the estate principal does not have adequate cash to pay the taxes, other principal assets must be liquidated in order to generate the necessary cash. Marital deduction. Now, in the computation of the taxable estate, recall that a marital deduction is allowed for the value of qualifying property passing to a surviving spouse. Now, the amount of the deduction is unlimited. No matter how large the estate, a bequest of all property to one surviving spouse will completely eliminate federal estate taxes for the decedent's estate. that statement is technically correct but incomplete. It should also state that the deduction may defer estate taxes only until the death of the surviving spouse. Upon the death of the surviving spouse, their estate may become subject to tax. Now, several alternatives are available for further reducing a marital couple's estate tax. Under current law, the decedent's unused gift and estate tax exclusion amount and resulting unused unified credit can be made available to the surviving spouse by the executor of the decedent's estate. Now, the portability of the exclusion amount means that a couple, in essence, has a combined exclusion amount of $10,680,000 for gift and estate tax purposes. Now, once again, it's important to note that this was at the time that the book was published in 2014, so I'm sure this amount has increased. So, once again, it is important to note that the portability of the exclusion amount is only applicable to the estate tax, not other taxes, such as the generation skipping tax. Now, the objective of using a trust in this instance is to maximize the use of the unified credit, but not just one of the spouses, but by both spouses. Now, a common form of trust used for this purpose is a credit shelter trust, as it shelters a portion of the total estate from estate tax by using the unified credit available to each spouse. Sometimes these trusts are also referred to as marital deduction trust, family trust, bypass trust, or AB trust. If these trusts meet IRS guidelines, they are not subject to the estate tax when the surviving spouse dies. If properly designed, the trust amount would be included in the decedent's taxable estate and incur tax but be offset by the unified credit. Now, not knowing which spouse would be the first to die, both spouses usually create a revocable trust during their lifetime. Then upon death, their trust becomes irrevocable and the surviving spouse terminates their revocable trust. Consideration should also be given to how the couple's assets are held. Valuation of assets included in the gross estate. For estate tax purposes, the assets included in a decedent's gross estate must be measured at fair value. Assets are included in the estate at their fair value on the date of the death or on an alternative valuation date. If the alternative valuation date is elected, all estate property must be valued as of 6 months after the decedent's death. This is except for property sold, distributed, or otherwise disposed of during the 6-month period. Such property is going to be valued as of the date of disposition. The alternative valuation date may be used only if it would reduce the total gross estate and decrease the estate tax liability. The alternative valuation date protects estates if there should be a significant decrease in property values during the 6-month interval. The recipient of assets from the gross estate must establish their inherited basis of the assets for the purposes of their own personal tax situation. The basis of property acquired from a decedent is the fair value on the date of death or alternative valuation date, and this may result in a stepped-up basis. The provision allowing for the step-up basis can result in significant tax savings if a decedent does not have an estate tax. However, if a decedent does have estate tax, in essence, the gain from stepping up the basis is going to be subject to the tax in the form of an estate tax rather than that of an income tax. Tax planning would suggest that the property that has appreciated substantially in value should be held as part of an estate because of the advantage of the step up in basis. Now, the opposite is going to be true if there is a substantial decline in value. Other taxes affecting an estate. So in addition to the federal estate taxes, about half of the states assess an estate or inheritance tax. that is on the value of the estate assets conveyed to its heirs. State inheritance tax are an allowable deduction against the gross estate in order to arrive at the taxable estate. Now, upon his or her death, the decedent's estate becomes a separate, distinct taxable entity that may continue to exist for some time until all estate assets are distributed. Estate income that is distributed currently and properly to a beneficiary generally is excluded from the taxable income of the estate. Therefore, the estate functions as a conduit through which the income passes directly to the recipient. Income passing in this manner retains the same character it had in the hands of the estate. So, for example, income passing in this manner, if the estate receives and distributes non-taxable income, such as interest on municipal bonds, the interest is going to remain tax-free in the hands of the recipient. Normally, the beneficiary is taxed on any taxable income that he or she receives, and the estate, as a separate entity, is going to be taxed on any income that it accumulates. So what are some trust accounting issues? A trust is a separate, distinct entity that receives assets from an individual for the purpose of managing and distributing them over a period of time. A trust is also recognized as a taxable entity until trust assets have been distributed and the administration of the trust is completed. Trust may be created for a variety of reasons. It is possible that heirs to an estate currently lack the maturity, sophistication, or prudence necessary to receive substantial assets directly. So therefore, a trust is established to manage the assets for the intended heirs. Trusts also provide opportunities for assets to be exempt from the probate process and, more importantly, taxes imposed on an estate. Trusts are used as a means to convey assets to special organizations or causes such as charities, universities, and other not-for-profit organizations. Trusts may take a variety of forms, and various strategies can be used to create a trust. A charitable remainder trust distributes the income from the trust assets to individual beneficiaries over a period of time. It's usually often the rest of their lives. And this is the time the assets go to the remainder, which must be a charitable organization. A bypass or credit shelter trust is designed to split assets between a surviving spouse and a trust so that the value of the marital deduction and unified credit are maximized. Generally, the surviving spouse is going to receive income during his or her lifetime, after which the trust assets are distributed to the surviving spouse or heirs. Now, a qualified terminable interest property trust, also known as a Q-tip trust, is going to be similar to bypass or credit shelter trusts. Trusts may be designed to accomplish a variety of purposes. They may become operative while the grantor is alive, or they may be created through a will to become effective upon the grantor's death. Now, the former type of trust is an inter vivos or living trust, while the latter is referred to as the testamentary trust. So what are financial accounting for trust? The accounting for a trust is very similar to the accounting for an estate. The distinction between principal and income must be maintained through the use of trust principal and trust income accounts. The trust agreement should provide direction regarding how income is to be determined. A charge and discharge statement is required periodically for both trust principal and income. And once again, on the bottom of page 1049, followed into page 1050, there's a good example of accounting for a children's trust. So if you would, just take time to go through this. And obviously, as you're reading through this chapter, it's important to read through all these examples anyways. That is it for chapter 20, estates and trusts, their nature and the accountant's role. I will have chapters 20 homework posted either sometime today or no later than tomorrow. Once again, chapters 20 homework is not going to be due until after Thanksgiving break, the Monday following Thanksgiving break, because recall that
This is the last week of class before Thanksgiving break, and then when we come back, Chapter 20 homework will be due, and we'll do the Exam 3 preparation. And once again, remember Chapter 14 homework is due this evening, about 11:55 p.m. And please do remember that I will not be posting the solutions until after the homework is due. Once again, that's all for today. I appreciate your all's time, and everyone have a good Thanksgiving break, because I won't be talking to or seeing any of y'all until then. And remember, as always, if anyone's having trouble with any of the content, please give me a call at my office phone. You can email me or come by my office. Once again, my office hours are Monday, Wednesday, Friday, 9 to 12. I'll be happy to help anyone with anything they're having trouble with. Once again, that's all. And have a good day, good rest of your week, and a good Thanksgiving break. And I'll see everyone after Thanksgiving break. Thank you.